Hello everyone, my name is Mortaza Alborzi. I'm in the financial business for past 25 years, and basically today I gathered together some information about money. I call it 1 to 10 of money, and with that I'm hoping to educate some public regarding make a better decision as far as financial planning for the future. Let's start with number one. What is it that next to the health issue that almost solve all the problem? I know your answer. You said money. Number two is the two kinds of money. We have green money and red money. Obviously, red is a sign of what? Danger. Your money is involved in the stocks, in a gambling or something like that. There is a chance of losing it. Green money is always safe, stays somewhere basically secure or in a matter of growth. Number three enemies of money. What are the three enemies of money? Number one is inflation. So if your money is somewhere above the inflation, that means you're making money. They give you return. Above the inflation means you're making money. If it's below the inflation, like bank, that means you're losing money. Number two, it's a risk. How do we avoid the risk? There is a strategy called index strategy. Obviously, you like to get the portion of market, where market grow, right? So this, if you pay attention about this red and green line, when market goes up and down, we basically don't have a control on it, right? But we could secure our money with putting it in a green line, which we call it index strategy. When market goes up, you get portion of market. When market goes down, you stay guaranteed level on whatever you made, so you're not losing money. And third enemy of money is tax. It's good to know that there are three ways of tax paying. Tax now, tax later, and tax advantage, which by the IRS code, I'm going to explain to you later on that area. 1988 Congress and IRS together, they came up with a tax code, Internal Revenue Code section 7702. That would have some tax advantage for you. And now number four. Number four is very important. It's basically very much eye-opener. There are four houses for money. People usually have in their mind bank, and then people making a little bit more money, they're investing in real estate also. And then if they have more money, they want to have some fun with their money, then they get involved in stocks and basically, if you know it or not, your 401k, your IRA, your mutual fund are involved in the stock. And number four, we're going to keep the name secret till we're done. So there are four concerns for money that people have. First and foremost, liquidity, right? Now we're going to go one by one, process these four steps to see how this works. At the bank, obviously your money is available for you to take out. So you could liquid your money. Risk, there is no risk guarantee, so we put again positive. Rate of return, considering is paying below the inflation, so it's negative, is sort of disgusting. Tax, obviously you gotta pay tax. So out of the four house, two of them are positive. 2 out of 4 are positive. Real estate, liquidity, you can't cash your home right away. Risk, obviously there is a big risk. Don't forget 2008, what happened. So there is a risk with the real estate also. Rate of return, yes, if you get the good location and you keep it for a long time, obviously you make a good money at the real estate. And tax, you have to pay tax. So in this case, 1 out of 4 is positive, right? Now, we'll go to the next one, stocks and bonds. Liquidity, we could put sometimes yes, sometimes no. So half a point, right? Because sometimes you can cash, you're way above the market, you can sell it in the black market. Risk, obviously, absolutely gambling. Rate of return, again, let's be fair and put positive and negative, because sometimes you make money, sometimes you lose money, right? And tax, again, you gotta pay tax, okay? When you pay tax, when we calculate this, half and half, again, become 1 out of the 4 house positive. All right? Now, if there is any product, which it is in the insurance industry, that liquidity, your surrender value is available for you to take money out of it. Risk, based on this green line, there is no risk whatsoever. Rate of return, 6 to 8% rate of return past 20, 30 years, I think is way, way, way above what savings account gives you. Tax, based on the tax code we mentioned, you don't even pay tax. But there are some other advantage comes with this, such as tax deferred growth. Later on, I'm going to explain to you that product. Supplemental retirement account, tax-free. Then emergency fund, if you want to take money out of it, no question, no limit. Of course, there is a limit up to 90% of what I call it, like a close to almost no limit. Then other benefits, it gives you number one reason for bankruptcy in the country, which is what? Terminal illness, critical injury, chronic illness, living benefit, right? Medical bills is the number one reason for bankruptcy in the country. Now, what this product is, as I said it, the green money here, what avoid all three enemies of money. Here, number 4. On number 8, I'm gonna break down in detail with you, but just for now, you need to know this name, Index Universal Life. Yes, we get that. Number 5, 5 ways that people spend money, okay? What is it that basically United States is number 1 in it? Spending, right? We even spend the money that we don't have on a credit card. What is it that we are almost last one, worst on it? Savings. And then investing, wasting, and leave a legacy. These are the 5 ways people use money. Number 6 is 6 jars of money. This is very fun to teach to your kids, to learn it from now. Go grab it, 6 jars of money from 99-cent store, stick the sticker on it, and write on it, first jar, 5%, and that's we call it angel, right? Angel is for giving. In life, you don't give, you don't receive. That's the law of universe, right? Second one is the fun. That fun, you could go to 5 movie theater, or you could save the money for that and watch the opera. Go watch the opera. When you do something, try to get the maximum out of it. Education, this is not a school. This is extra book you study, extra workshop you take, seminars you take, in order to grow yourself, become a better person. Next one is necessity. Obviously, an adult has grocery, utility, mortgage, bills, rent, and pay different payments, and you use this box, this jar for that one. Next one is long-term saving for spending. Long-term saving for spending. What does that mean? You're saving money to buy your house as a down payment. You're teaching your kid, hey, you're gonna put the down payment, start saving from the age 13, 14 for the down payment of your car. So by that time, I'll take care of the payment. You pay the down payment so you care about your car. That's that kind of spending. Next one is FFA, stands for Financial Freedom Account. Never touch that until the day you decide to get retired. That's the one on number 8. I'm gonna break it down for you what it is. So that's about 6 jars of money. Now number 7 is the rule by Albert Einstein. You know that, right? It's not a financial industry or Federal Reserve Bank rule. It's the rule by Albert Einstein. He designed and created this rule that whenever in a life we divide the number 72 to the interest rate, is giving us the number of the years takes your money in that specific account become double. What does that mean? If you have an account and pays you 1% rate of return, 72 divided by 1, yes, it takes 72 years your money become double. But what is the typical CD pays right now at the banking system? About 0.5%. So every 144 years your money become double. What about a saving? Typical saving, 0.02. 72 divided by 0.02, every 3,600 years your money become double at the bank. Good luck. So in this case, we are comparing two 18 years old. We give each one $5,000, and we want to know what's going to happen on their retirement account, on the retirement age. So we're going to be fair, and we're not going to calculate these numbers by the bank. We're going to give them the number that before 9/11 banking system was giving away. Okay? So about 4% rate of return. Based on 4%, 72 divided by 4, it gives us every 18 years, right? He's 18, he has a 5,000, 18 years later he's 36, his money will come double to 10,000. 18 years later at age 54, he's gonna have double the money, 20,000, and 18 years later by age 72, he's gonna have $40,000, right? But you're familiar with this hat, right? That's your favorite uncle, Uncle Sam. He wants his share. What do you mean by that? Yeah, Uncle Sam, that was my own money. I'm not talking about that one, I'm talking about this one. I need a tax on that one. What's your tax bracket? If it's 30%, good luck you take out with something around $30,000 after 54 years you waited, right? By that time, I think you could buy a scooter or bicycle by that money, right? So what is gonna happen on this side? This side is a combination of investment. Let's say it gives an average of 10% rate of return. Now every 7 years our money will come double. If we go with the 7 years, for example, you see the same 18 years old, as every 7 years his age goes forward, his money become double. By the time it's 2 years apart from this one, it's $1,280,000. Even if he pays 50% tax, I want you to compare this money, half of this will be this one, with this money. Just because of the rate of return difference. But he matched the money he made at age 72 by age 39. Okay? So this is a formula that we use, this is the strategy we use, rule of 72, for the number 8, which basically I call it 8 wonder in the world. What is that? As I said over there, 1988, Congress and IRS came up with a tax code, Internal Revenue Code Section 7702, and means if you growing some money under the umbrella of your life insurance and you follow the limit, you don't cheat and you don't do money laundering, right? There is a limit for it. Then this plan works this way. The money you put in there monthly or annually, let's say a small policy, $500 a month, 30% of that money goes plus minus to this side and become a cost of your life insurance. I'll tell you later on what it would do for you. So that 30% plus minus is because of what? Because you're possibly female, you're not smoker, you're healthy, your driving record is good, your risk at your job is low, and things that insurance company consider to rate you as far as health and basically risk. 70% plus minus of the money. In this case, we're talking about a healthy, like a 30 years old. 70% plus minus goes that side, and your money based on rule of 72, based on that percentage, starts growing. Okay? Now, if you want to take some money out, it's not 401k, and you're not allowed to touch up to 59.5. It's your money, you lend it from this pocket to that pocket. But with that comes life insurance, and the money you raise, if you don't want to touch it, you want to use it for the retirement account, you can use it as a supplemental retirement account. And I have a clients that the way that they design their policy, they're getting $200,000-300,000 tax-free for 20 years as a supplemental retirement account per year. Okay? Now, let me show you how these things break down of this for you, that how it works. Secure versus insecure. What is it that cover all 4 areas of financial planning? Okay? Here, this is a traditional way that we've been told by our parents how we set up our financial life. Usually parents tell the kids, hey, as soon as you have money, go buy a house. House is asset, house is everything, but we know house is not asset for us. House is an asset to the bank and liability to us until you pay off the house. Then on top of that, go invest, go do business, make money out of your money. On top of that, don't forget to put 6 months money on the side, under your pillow or at the bank for the emergency fund. And then they tell us, what is this thing they call it? Insurance. Go get a protection too, it's not bad. What do we do here? Our financial life depends on this point. Is this stable? Is this secure? In case of layoff happen, who's gonna pay the payment for this? Who's gonna pay the payment for this? In case of disability or death, who's gonna pay the payment for this? So the whole plan collapses. Every educated and smart person that is working with a licensed agent that knows the product would design your program completely opposite. On the bottom, you have a strong foundation and insurance. On top of that, you build the emergency fund and you keep it on the side. God forbid that something happened, you don't miss the payment of this one. Next to that, you have a great investment, and on top of that, there is the money. You want to buy a house or mansion or whatever you want. But today I'm going to show you how all 4 steps of financial planning would get covered by this simple life insurance policy. Insurance and protection. You got it as a protection and insurance. Emergency fund. Anytime you want to take money out, is available for you. Your surrender value. Investment. Show me one investment that you raise millions of dollars and you don't pay tax. That's the amount that is covering. And do you have money at the end to do whatever you want to do? Right here. So one plan that covers 4 steps of financial planning and is absolutely secure. Why? Because of that green line that you never lose a penny on your account. Now, what else this plan cover? There are how to 10x your life and cover all 3 areas of your life. This is very significant. This is 3 areas that's happening to our life no matter what. We either die too soon, wife has to raise a couple of kids, right? Family needs money, or the loved ones needs money, those that they depend on your income. Or we live too long, now we need money for our retirement or vacation or whatever our plan was. But, big but, number 1 reason for bankruptcy in a country, 62, some say 67% of bankruptcy in this country is because of what? Medical bills. And you're thinking, how these medical bills had to do anything with the life insurance? If you never heard it, you have the old product. The new product, that amount is available for you in case of terminal illness, chronic illness, critical illness, and critical injury. Cover all of them, right? So, one plan again that covers 4 steps of financial planning and 3 areas of life completely. Now, people can start this plan from coffee a day, $3, $4, $5 a day. Or I have a bunch of clients that they taking advantage of this. They, as an executive bonus plan, key person or buy-sell agreement or a corporate plan, we do this for their own. And guess what? The cost of this, they put $3, $4, $5,000 a month in that. We get as a cost of business deducted, the tax bracket comes down, and they create the wealth for themselves and the family. Now, many ways that many businesses, they want to do this plan instead of 401k, put it on their defined benefit plan or defined contribution plan. We do this, design it for them to, again, keep the employees that they don't want to lose ever. They hardly train them, they're loyal, they're good, and they don't want to lose them. With this, you basically lock on your employee. They see a great retirement, great living benefit and everything. They're not going anywhere. With that, if you have any question, my name is Mortaza Alborzi. My number is 310-922-2242. 310-922-2242. And my email address, as you say very easy, from dreaming to doing @gmail.com. Hope you enjoy the information. Thank you so much.